Hello traders, you're welcome back to the Forex Geek channel and you're welcome to this video. So if you're looking to elevate your Forex game, then you are in the right place because we cover a lot of beneficial information in this channel. Okay, so stay tuned. If you're not yet subscribed, then I think now is the good time to do that. Okay. So today we're going to be looking at dispersion trading. Okay, in this video we're going to be looking at dispersion trading. It's not your typical trend following or scalping method. Instead, it focuses on volatility and relationships between currency pairs. All right, so let's get into what makes dispersion trading so intriguing and why it might just be the missing piece in your Forex strategy. So first off, what exactly is dispersion trading? In simple terms, dispersion trading is a strategy that leverages the relative volatility among different currency pairs. So instead of betting on a single direction like buying, if you think the euro will go up against the dollar, dispersion trading uses a different methodology. Dispersion trading involves looking at how different currency pairs behave in relation to each other. So essentially we are looking at the spread of volatility between pairs, not just their price movements. So now let us imagine, imagine you have two currency pairs that usually move similarly. This is the Euro USD chart, and then this is the GBP USD chart. Now, it's not like they exactly have the same price movements per se, but sometimes, they might move similarly. As we can see currently, you can see how the movement of the Euro USD is. You can see how the movement of the GBP USD. Can you see that there is some similarities? Okay, so GBP and USD, sometimes they can have similar price movements. Okay, so imagine you have two currency pairs that usually move similarly, like the Euro USD and the GBP USD, as I just showed you. Dispersion trading will involve taking a position based on the volatility relationships between them, potentially betting that one pair will experience more volatility than the other. When done right, this approach allows you to benefit from volatility differences without having to predict an exact price direction. Okay, so why is dispersion trading worth considering? First, it can be especially useful in volatile or uncertain market conditions where predicting direction is tough. So instead of needing to forecast whether prices will go up or down, dispersion trading allows you to benefit from relative changes in volatility. It's almost like you are taking a hedged position across multiple currency pairs, so you are not reliant on one big market move. Okay, this is why dispersion trading is also popular in equity and options market, right? Traders use it to spread their risk across several assets, capitalizing on volatility spreads rather than taking big directional bets. Okay, so it's similar in Forex, where the approach focuses on currency pairs with historically strong correlations or specific volatility dynamics. Okay, so let's break down how it works in Forex trading. Dispersion trading involves multiple steps. You start by analyzing the correlations and volatilities of different currency pairs. This means identifying pairs that tend to move in sync or have similar volatility patterns, as we just identified between GBP USD and Euro USD. Okay, so once you have chosen a set of pairs, you create positions that capitalize on changes in their volatility. So suppose Euro USD has been relatively stable, but GBP USD has shown increased volatility due to some economic news. With dispersion trading, you might short the pair with lower volatility and go long on the pair with higher volatility. As these pairs adjust to market events, you are banking on the spread between their volatilities to provide a profit opportunity even if the market moves sideways. Okay, now dispersion trading isn't without its challenges. It's a more complex strategy and often requires a deeper understanding of correlation analysis and market behavior. All right, you'll need tools and data to track volatility spreads and currency pair correlations accurately. Also, like any strategy, it comes with risks. Okay, if the correlations between currency pairs shift unexpectedly, or if volatility changes in unforeseen ways, your trades could take a hit. On the upside, this approach gives you flexibility and diversification. Since you are focusing on volatility instead of just price movement, you can potentially achieve more stable returns over time, especially in choppy markets. Plus, with dispersion trading, you are less affected by market shocks that impact only a single currency pair, as you are diversifying across multiple pairs. Okay, so if you are interested in giving diversion trading a shot, you might want to start by doing your homework. All right, study the correlations between major currency pairs and understand how economic events impact their volatility. Okay, there are various tools out there like volatility indices and correlation heat maps that can help you with this analysis. Also, start small. Dispersion trading can be complex, so it's best to test it out in a demo account or with low risk trades until you get comfortable. All right, once you're confident, dispersion trading can be a valuable addition to your toolkit. It's an innovative strategy for traders looking to manage risk and benefit from the intricacies of market behavior. So if you found this breakdown helpful and you are excited to try dispersion trading, don't forget to hit the like button, and if you're new here, subscribe and click the notification bell so you never miss out on new forex strategies and trading insights. Let's keep building our trading skills together. Thanks for watching, and I'll see you in the next video.